The consensus on Palantir is simple and seductive. Defense budgets are rising, AI is becoming the decisive edge in modern warfare, and Palantir, with its Gotham platform embedded in U.S. military operations for over a decade, is the obvious beneficiary. That story has been driving the stock's premium valuation for months. But here is the problem with obvious stories. They tend to price in outcomes before those outcomes arrive, and when the underlying mechanics are examined carefully, the picture becomes considerably more complicated. Palantir operates two distinct business lines, government and commercial. The government side, which includes defense, is real, established, and growing, but it is not the engine driving the current valuation multiple. The commercial side is, and that is a meaningful distinction because the risk profiles of those two revenue streams are completely different. Defense contracts are sticky, long cycle, and politically durable. Commercial AI contracts are competitive, short cycle, and vulnerable to any slowdown in enterprise spending. When investors bid up Palantir as a defense AI play, they are partly paying for a characteristic that represents the smaller part of its near-term growth narrative. To understand where Palantir sits in the AI hierarchy, it helps to look at what is happening one layer beneath, in the infrastructure that makes defense AI possible at all. This week, Nvidia took a $2 billion stake in Marvell Technology, pairing it with a deeper expansion of its NVLink Fusion ecosystem. The move is strategically significant in a way most coverage missed. Nvidia is not just investing in a partner, it is formally acknowledging that its largest customers, hyperscalers and, increasingly, defense-adjacent operators, are building custom silicon alongside Nvidia gear, not instead of it. Nvidia's data center networking revenue hit $10.98 billion in the most recent quarter, up 263% year-over-year. That number matters because Palantir's entire value proposition rests on the software layer above hardware like this. Gotham and AIP, Palantir's AI platform, are only as powerful as the infrastructure they run on, and right now that infrastructure is being rebuilt at a pace that no single software vendor fully controls. There is also a less discussed dynamic operating in the background. Amazon, one of the largest cloud providers running defense workloads, just lost a second senior executive from its Annapurna Labs chip division, the team behind the Trainium AI accelerators that power workloads including Anthropic's Claude models. Two senior departures from a chip team at a critical juncture is not a routine personnel transition. It raises legitimate questions about execution continuity in AWS's custom silicon strategy, which is the same infrastructure layer that defense AI customers increasingly depend on. If AWS's chip roadmap slips, the downstream effect reaches every AI application running on that cloud, including platforms like Palantir's. Here is the reversal card. The most important thing happening in AI right now is not who has the best software or the deepest defense contracts. It is a valuation reset at the infrastructure level, and what that reset implies for everything built on top of it. Nvidia, the most direct beneficiary of the AI build-out, is now trading at forward earnings parity with the S&P 500 for the first time in over a decade. Goldman Sachs noted that Nvidia's forward price-to-earnings ratio has fallen to match the broader index, ending a 13-year premium streak. Analysts still project Nvidia's earnings to grow over 70% this fiscal year, and Nvidia alone is expected to account for roughly 21% of total S&P 500 earnings growth in 2026.
That disconnect, infrastructure earnings accelerating while infrastructure multiples compress, creates a structural contradiction for software plays like Palantir. If the market is unwilling to price a premium into Nvidia at these growth rates, on what basis does a defense software platform with thinner margins and slower burning contract cycles command a richer multiple? The answer the bulls give is scarcity. There is no other publicly traded pure play on defense AI at scale. That argument has merit, but scarcity premiums are fragile. They compress the moment a credible competitor emerges, or the moment the underlying theme shifts from anticipation to accountability, from promising pipelines to delivered results. Jensen Huang's claim last week that AGI has already been achieved, framed around Friedman's definition of an AI that could build a billion-dollar business, was met with immediate skepticism from researchers. Google DeepMind, the same week, published a cognitive framework identifying 10 faculties where current AI systems still dramatically underperform average humans. The gap between AI marketing language and measurable AI capability is not closing as fast as stock prices suggest. The bull case for Palantir is conditional, but it is not weak. The condition is this: defense AI spending must shift from procurement to deployment at scale, and Palantir must be the platform that captures that deployment. There are real indicators pointing that direction. The U.S. military has been running live operational deployments of Palantir's Gotham system. The Maven smart system, which Palantir now operates, processes real battlefield intelligence. These are not proof-of-concept installations. If the geopolitical environment continues to intensify, and the Iran war context driving recent tech stock volatility suggests it will, defense AI budgets will face less political resistance, not more. In that scenario, Palantir's government revenue becomes the anchor that justifies patience on valuation. The commercial AIP business, growing rapidly, becomes the optionality layer that could eventually close the gap between current price and intrinsic value. The bear case is also conditional. It does not require Palantir to fail. It only requires the gap between narrative and near-term financial delivery to widen. At current multiples, the stock is pricing in a future in which Palantir becomes the operating system for AI-enabled defense, not just a vendor, but a platform. That is a much higher bar than being a well-regarded contractor with a growing commercial arm. The infrastructure volatility is real. Amazon's chip team instability, Nvidia's valuation compression, and the geopolitical uncertainty that IRGC threats have introduced into the tech sector are all signals that the environment Palantir is operating in is more fragile than the defense AI narrative implies. Tesla, also named in the IRGC threat list, is down 19% year-to-date with its own overextended narrative problem. The pattern of premium-valued AI adjacents running into execution reality is not a coincidence. Evidence leans toward Palantir maintaining its strategic position, but only if contract-to-planet velocity accelerates in the next 2 quarters. A delay in operational scaling or any sign that AIP commercial growth is decelerating would expose the valuation to a compression that the infrastructure reset has already begun signaling. The more durable insight may be this. The companies quietly building the unglamorous layer beneath the defense AI story, power grid flexibility, custom silicon, networking interconnects, are being validated by actual capital commitments. Nvidia's $25 million backing of Emerald AI, a company solving grid access for AI factories, is a smaller headline than the Marvel deal, but it points to where the structural bottleneck actually lives. Defense AI does not run on narratives. It runs on watts, wafers, and bandwidth. The companies solving those constraints may end up mattering more than the ones selling the story.